1929. The United States stock market had been climbing for 9 straight years. The Dow Jones had increased 500%. Everyone from Wall Street bankers to shoeshine boys was investing. People were buying stocks on margin, meaning they were borrowing money to invest, convinced the boom would never end. Warning sign number 2 was flashing bright red, excessive leverage and debt-fueled speculation. But nobody cared because everyone was getting rich. October 24th, 1929, Black Thursday. The market opened and immediately started falling. Panic selling began. 5 days later, on Black Tuesday, the market crashed 25% in a single session. But here's what makes the Great Depression different from every other crash. It didn't stop. The market continued falling for 3 years, ultimately losing 89% of its value. 89%. If you had $100,000 invested in September 1929, by July 1932, you had $11,000 left. Unemployment reached 25%. Banks failed by the thousands. An entire generation lost everything. Now, most people think the 1929 crash caused the Great Depression. That's wrong. The crash was a symptom, not the cause. The real problem was what came before: an entire decade of wealth inequality, agricultural collapse, and unsustainable debt. Warning sign number 3, when economic fundamentals and market prices completely disconnect. The economy was already fragile. The crash just exposed it. And then the government made it worse with terrible monetary policy, raising interest rates when they should have lowered them, turning a recession into a decade-long catastrophe. Here's the uncomfortable truth. We're seeing similar patterns today. Massive wealth inequality, record debt levels, asset prices disconnected from economic fundamentals. The setup is eerily familiar. But before we get to today's warnings, you need to understand the other crashes first, because the pattern becomes obvious once you see all the pieces. 1995 to 2000. The internet was brand new, and everyone knew it would change everything. And they were right. But that didn't stop the biggest speculative bubble in modern history. Companies with nothing but a .com domain name were raising millions in IPOs. Pets.com, web ban. Boo.com, companies with zero revenue and zero path to profitability were valued in the billions. Sound familiar? At the peak, the Nasdaq had risen 500% in 5 years. Tech stocks were trading at price-to-earnings ratios over 100. Traditional metrics didn't matter anymore. Analysts created new metrics like eyeballs and clicks to justify insane valuations. Investors poured money into any company with .com in its name. Day trading became a national obsession. This is warning sign number 4, when valuation metrics are abandoned in favor of storytelling and hype. Federal Reserve Chairman Alan Greenspan famously called it irrational exuberance, but prices kept climbing anyway. March 2000. The Nasdaq peaked at 5,048. Then reality hit. Companies started running out of cash. Earnings reports showed massive losses with no end in sight. Investors realized that most .coms had no viable business model. The selling began. By October 2002, the Nasdaq had crashed 78%. $5 trillion of market value evaporated. Hundreds of internet companies went bankrupt. Pets.com, which spent millions on Super Bowl ads, shut down after just 9 months as a public company. Entire fortunes disappeared. The .com crash taught us that innovation doesn't justify any price. That revenue and profits still matter. That bubbles always burst. But here's the problem: we learned nothing. Because just 8 years later, we created an even bigger bubble. One that nearly destroyed the entire global financial system. And this time, it wasn't about tech stocks. It was about something much more dangerous: housing. October 19th, 1987. In a single day, the stock market lost 22% of its value. Trillions of dollars vanished. Retirement accounts destroyed. Families ruined. And here's the terrifying part: most investors never saw it coming. Throughout history, the market has crashed over and over again. Tulip Mania in 1637, the Great Depression, the .com bubble, The 2008 financial crisis. Each time, millions of people lost everything. But here's what nobody tells you. Every single crash followed the exact same pattern. And that pattern is happening right now. I've spent months analyzing every major market crash in recorded history. From the South Sea bubble of 1720 to the COVID crash of 2020. I've studied the data, read the research, and identified the 5 warning signs that appear before every single collapse. What I discovered will completely change how you see the stock market. Because right now, in 2026, we're seeing 4 out of those 5 warning signs flashing red. Here's why this matters to you personally. The average market crash wipes out 40% of investor wealth in less than 18 months. That means if you have $100,000 invested right now, you could be looking at $60,000 by next year. But it gets worse. Most people make the same critical mistakes during crashes, turning a temporary loss into a permanent disaster. They panic sell at the bottom. They chase false recoveries. They ignore the warning signs until it's too late. And the crazy part? Every crash in history could have been predicted if people knew what to look for. So in this video, I'm breaking down every major market crash in history. You'll discover exactly what caused each one, the warning signs people missed, and most importantly, the pattern that connects them all. Because once you see it, you can never unsee it. Let's start with the crash that changed everything. 1637, the Netherlands. A single tulip bulb sold for more than 10 times the annual income of a skilled craftsman. People were literally selling their homes to buy flowers. Sounds insane, right? But this was the world's first recorded speculative bubble, and it set the template for every crash that followed. Here's what happened. Tulips had just been introduced to Europe from Turkey, and wealthy merchants became obsessed with rare varieties. Prices started climbing. Then something interesting happened. Regular people noticed that tulip traders were getting rich, so they started buying too. Not because they wanted flowers, but because prices kept going up. Taverns became trading floors. Blacksmiths and bakers were speculating on tulip futures. At the peak, a single rare bulb cost as much as a canal house in Amsterdam. Everyone was convinced prices would keep rising forever. This is warning sign number 1. When average people start investing in something they don't understand simply because prices are rising. February 1637. A routine tulip auction failed. Nobody showed up to buy. Panic spread instantly. Within days, tulip prices crashed 99%. Fortunes vanished overnight. Here's the critical lesson. The crash didn't happen because tulips became worthless. It happened because everyone realized at the same time that they'd been buying tulips they didn't want, at prices that made no sense, only because they expected someone else to pay more. This is the greater fool theory, and it's behind every bubble in history. Now, you might think Tulip Mania was just historical madness. But the exact same pattern has repeated over and over. The South Sea bubble of 1720. The railway mania of the 1840s. Every time, it's the same story, a new innovation or opportunity, rising prices, mass speculation, and then sudden collapse. And every time, people say this time is different. It never is.
2000 to 2006. U.S. housing prices doubled in 6 years. Everyone believed real estate only goes up. Banks were lending to anyone with a pulse. No income verification. No down payment. Subprime mortgages with teaser rates were packaged into complex securities and sold to investors worldwide. Wall Street was making billions in fees. Homeowners were using their houses as ATMs, borrowing against rising values. Warning sign number 5, when debt reaches unsustainable levels across the entire system. This wasn't just a bubble. It was a ticking time bomb. Here's what made 2008 different. In the dot-com crash, people lost money on stocks. In 2008, the entire financial system nearly collapsed because banks had taken those risky mortgages and created derivatives, then derivatives of derivatives. They used massive leverage, sometimes 30 to 1, meaning for every dollar they had, they'd borrowed 30. When housing prices stopped rising, the whole system unraveled. Bear Stearns collapsed. Lehman Brothers went bankrupt. AIG needed a government bailout. The credit markets froze completely. Companies couldn't borrow money to make payroll. September 29, 2008. The Dow Jones dropped 778 points in a single day, the largest point drop in history at that time. But the real damage happened over 18 months. The S&P 500 fell 57% peak to trough. 8.7 million jobs were lost. Unemployment hit 10%. Foreclosures destroyed 9 million families. Retirement accounts were cut in half. The total wealth loss was $19 trillion. This wasn't just a market crash. It was an economic catastrophe that took a decade to recover from. Now here's where it gets really interesting. Every crash we've covered follows the exact same 5-step pattern. Excessive optimism, rising prices that disconnect from fundamentals, massive leverage and debt, a triggering event, and then panic selling that feeds on itself. Tulips, stocks, tech, housing. The asset class changes, but human behavior doesn't. And right now, as we speak, we're in the middle of the same pattern. But there's one more crash you need to understand first, because it proves the pattern works even in the modern era. February to March 2020. The COVID pandemic hit, and the stock market experienced the fastest crash in history. The S&P 500 dropped 34% in just 33 days. Faster than 1929. Faster than 2008. Global markets lost trillions. But here's what makes the COVID crash fascinating. It was the first crash where we actually knew what caused it. A global pandemic that shut down the entire economy. No speculation. No leverage bubble. Just a genuine economic shock. But what happened next changed everything. Central banks around the world printed money on a scale never seen before. The Federal Reserve cut rates to zero and pumped trillions into the system. Governments sent stimulus checks directly to citizens. And the stock market did something that shocked everyone. It completely recovered in just 5 months. By August 2020, we hit new all-time highs. The disconnect between the economy and the market became absurd. Unemployment was at depression levels, yet stocks kept rising. Why? Because central banks had essentially guaranteed they wouldn't let markets fall. And that created what financial analysts call the everything bubble. Stocks at record highs. Real estate at record highs. Cryptocurrency exploded. NFTs sold for millions. Meme stocks like GameStop defied all logic. Special purpose acquisition companies raised billions with no actual business. We saw every single warning sign appear simultaneously. Excessive speculation, disconnection from fundamentals, massive leverage, retail investors piling in without understanding what they're buying. It was .com and 2008 combined and amplified. The only question was, when would it pop? 2022 to 2026. Interest rates rose dramatically to fight inflation. Tech stocks crashed. Crypto collapsed. Several banks failed. But here's what's concerning. The underlying problems never got fixed. Debt levels are higher than ever. Asset prices are still elevated. And we're seeing speculation return in different forms. The pattern is still active. Which brings us to the most important part of this entire video, what these crashes teach us and what you need to watch for right now. After analyzing every major crash in history, the pattern is undeniable. Stage 1. A legitimate innovation or opportunity emerges. The internet. Housing. New technology. Stage 2. Prices start rising, attracting attention and capital. Stage 3. Speculation takes over. People stop buying because of value and start buying because prices are rising. Stage 4. Leverage and debt amplify the bubble to unsustainable levels. Stage 5. A triggering event causes sudden recognition that prices are too high, and panic selling creates a self-reinforcing collapse. Every crash. Same pattern. Different assets. So, what are we seeing right now in 2026? Warning sign 1. Mass participation in assets people don't understand. Check. Millions investing in complex instruments they can't explain. Warning sign 2. Excessive leverage. Check. Margin debt remains elevated and private credit markets are massive. Warning sign 3. Fundamental disconnect. Check. Many stocks trade at valuations that require perfect execution for decades. Warning sign 4. Abandonment of traditional metrics. Check. We justify prices with narratives instead of numbers. Warning sign 5. Unsustainable debt. Check. Government, corporate, and consumer debt are all at record levels. Now, does this mean a crash is coming tomorrow? No. Bubbles can stay inflated longer than rational people think possible. The dot-com bubble had warning signs for years before it popped. But here's what history teaches us. When all 5 warning signs are active, the risk is real. And when the crash comes, it happens faster than people expect. The time to prepare is before the panic starts. Not because you can time the market, but because you can protect yourself from making the emotional mistakes that turn temporary losses into permanent devastation. The real lesson from every market crash isn't about predicting when they'll happen. It's about understanding that they will happen. Markets crash. It's not a question of if, but when. And the investors who survive and thrive are the ones who prepare, who don't panic, and who see crashes as opportunities rather than catastrophes. Which brings us to the final critical question: what should you actually do about this? Every market crash in history teaches us 3 critical lessons. Lesson 1. Markets always recover, but individual investors often don't. The S&P 500 always came back, but families who panic sold at the bottom never did. Lesson 2. The best opportunities come during crashes, not before them. Warren Buffett famously said to be fearful when others are greedy and greedy when others are fearful. Lesson 3. Diversification and cash reserves are your best protection. Not market timing, not predictions. Just boring, simple preparation. So here's what you need to do. First, understand your actual risk tolerance. If a 50% market drop would cause you to panic sell, you're taking too much risk right now. Reduce exposure before the crash, not during it. Second, build cash reserves. Not to time the market, but to avoid being forced to sell during a crash and to have capital when opportunities appear. Third, diversify beyond stocks. Real assets, bonds, international exposure. Fourth, avoid leverage. Debt amplifies losses just as much as it amplifies gains. And fifth, educate yourself. The more you understand market history, the less likely you are to panic when history repeats. Here's the ultimate truth about market crashes that nobody wants to hear. They're inevitable, they're painful, and they're also absolutely necessary. Crashes clear out excess speculation. They reset valuations to sustainable levels. They remind us that markets are not magic money machines, but mechanisms for allocating capital to productive uses. The question isn't whether you'll experience market crashes in your lifetime. You will. Multiple crashes. The question is whether you'll be prepared. Whether you'll panic with the crowd or capitalize on their fear. Whether you'll learn from history or be doomed to repeat it. Every major crash in history followed the same pattern. Tulips, stocks, tech housing. The assets change, but human nature doesn't. Greed, fear, panic, hope. These emotions drive markets far more than fundamentals ever will. And right now, we're seeing the same warning signs flashing that appeared before every crash. That doesn't mean you should panic. It means you should prepare. If this video opened your eyes to the patterns behind market crashes, hit that subscribe button. I break down complex financial topics every week so you can stay ahead and make informed decisions. Remember, the investors who survive crashes aren't the ones who predict them. They're the ones who prepare for them.